After 40 years of declining mortgage interest rates, we're starting to see interest rates go the other direction. And depending on who you are in this economy, depends on how you feel about the housing market, because the market is changing very quickly. And even today, we saw the inflation rate come out at 3.3%, well above the Fed's 2% target. And this is really drastic for the bottom 80% of consumers, which is this exact story that we're going to be talking about today, is that there's an entire generation, an entire group of people who are being completely left behind in the housing market, and it's not getting better, it's actually getting worse. Let's dig in to see what's happening. So, to be honest with you, home ownership is the bedrock of financial success in the United States. It has been for a long period of time, but this is changing because the next generation financially is locked out from buying a house without help from family and friends and other factors. A big part of this is because there's just a massive wealth disparity in this country that gets worse every single year. Obviously, you can see that the middle class wealth over the years has just been dwindling down, while the top 1%'s wealth has been moving up, and the concentration is causing this impact in real estate, which is who's going to be the next buyer of real estate at these prices, because the middle class simply cannot afford to own property anymore at the prices and at the mortgage rates that we're at. And if mortgage rates continue to move up, it's going to continue to sideline the middle class, who really does want to buy real estate. So the demand is there, but we're in an absolute affordability crisis that is causing this drastic wealth divide to continue even further. So this is a staggering statistic. The top 10% of U.S. households now own 93% of all financial assets, and they also control about 50% of the spending, which is incredible. So we're seeing records concentration of financial assets and of spending. And obviously, if you're in the middle class, you are extremely frustrated with what is going on right now, especially if you didn't buy a house during 2020 to 2022 at record low rates. So you can see how is the wealth divided in the United States. This comes from the source of the Federal Reserve. It's the top 1%, the top 20%, the fourth 20%, the middle class. The middle class's share continues to get smaller and smaller, while the top 1%, the top 20% continue to advance. And this is really what we're seeing in the marketplace right now. We're seeing the middle class get totally squeezed. They're loaded up with debt. They're trying to rub two nickels together to even rent an apartment or buy a place. And you see the top 1% buying multiple properties. We're seeing record sales in luxury areas across the United States, but the middle of the pack, the 200 to 300,000 or even the 400 to 500,000 are getting stuck, and those number of sales are actually declining. So this is what we call the K-shaped economy. And basically, here's the same thing. It says the top 10% own 93% of stocks. The bottom 50% own 2.5%. So what happens is when we have an inflationary period, which means asset prices and prices are moving up, the asset owners, the people who own those assets, continue to see their wealth compound, but the people who don't own any assets, they continue to lose versus their wages, and they fall behind. So non-asset owners, home costs 5 to 7x their income. The rent is 30% of their income since 2020, and they're falling further behind. And this is why the market depends on completely who you are in the economic ladder and what you do basically for a living, and whether you're in one of those industries that's expanding and you own the assets, or it's one of those where you're basically just an employee earning a wage and you're falling behind. And since 2020, since the government put record low interest rates and started handing out money to everybody, that pushed this kind of change in asset owners and non-asset owners to an extreme and really accelerated the wealth divide in this country that is absolutely impacting the housing market today. So another factor to look at is how much do people save, right? Back in the 70s and 80s, people would save between 10 to 13% of their income and usually invest that money. Since the 2020 time period, it's been obviously drifting down, but now it feels like a recessionary period where people just don't have any money anymore. Now it's 2.7% of people's money is going towards savings, and it gets worse. A lot of the money is actually going out the door to pay for their debt that they have, and there's an overwhelming level of consumer debt as well as federal debt, and that's why we're starting to see interest rates move up. The risk has increased in the market to where we're probably in a bubble territory with the numbers that are coming out. And let's dig into what that looks like. And before we do that, one last thing. This is a chart I put out last week on the wealth by generation, which is very interesting. Obviously, the older you are, the more wealth you should have, hypothetically. But there's so much wealth in the boomer and the silent generations and older, that 62 years and older, that has this concentration of wealth. They bought houses that doubled, tripled, quadrupled in price. They bought stocks that have gone 10 to 20x. And meanwhile, you see the next generations on a relative basis, they are way behind these other generations in terms of their wealth building. And so there's a divide, not just by the concentration of wealth, but also the generational wealth, and it's accelerating at a very quick level. And Gen Z's not even on the chart. You can't even see them there. They don't really have any wealth, as much wealth now. Now, a lot of people say, okay, well, this wealth here is going to transfer to the next generation. It doesn't apply equally, right? The majority of people do not generate any sort of inheritance. It's usually the top 10% super wealthy people giving their inheritance to their wealthy children who already have a leg up. So it doesn't really help the market when this transfers. And also when it transfers, there's going to be a lot of baby boomers who sadly pass away. There's estimates up to 48 million in the next 20 years. And they have a lot of houses. 70% plus of them own a house. Those houses will come onto the market in some form or fashion eventually, and ultimately come to be a house that needs to be filled with somebody. Well, we're seeing the birth rates decline to like 1.2, 1.3. And that means that we're not above replacement value. So who in 20 years from now, 30 years from now, who is going to be buying these houses? These people don't exist, and these people here won't exist either. So it's like, who in the Gen X millennial will? So that's why we're saying demographics are destiny. And what we're likely to see is that when these people pass, and when we don't have people having as many kids, if there's not some sort of immigration into this country, we're going to have a lot of vacant sitting units out there in the marketplace, and it's going to distress basically the values and push prices down, which honestly we badly need, but it's not for healthy reasons, it's for unhealthy reasons of what's going on with the population. Now we're seeing what's happening in the bond market be a little bit interesting with what's going on. We're seeing GFC levels, great financial crisis levels of rates spiking, and this is not a good thing. This means that the bond market is viewing these as more risky assets, so they don't want to be holding treasuries as much. They don't want to be holding mortgages as much. You have to give the investors a higher yield to be able to hold those assets. And it's likely that this will continue to be the trend moving forward. Now, I know the government is trying to step in to do whatever they can to prevent interest rates from moving higher. They're harassing Fed officials, basically. They're going after whatever tools and resources they can use at the Treasury to buy these long-dated 30-year bonds that aren't trading very well, so there's not some sort of spike. They're using whatever tools are available to not have some sort of bond crisis, especially going right into midterms. And this is something that we're going to see moving forward, is a lot of government intervention. Obviously, a lot of us don't want the government intervention. We want things to reset back to normal, but the government can't help itself, right? They want things to keep going smoothly so that they can remain in power. This is true on both sides. Every side does this. They try to control the economy through interest rates. That is why the Fed is supposed to be independent as much as it possibly can from the politics, and just supposed to focus on their targets, but they're not focusing on their targets. We saw again the inflation rate come out at 3.3% this morning, and the target is 2%. So the Fed has been behind for 2 to 3 years on actually following their own targets and mandates from Congress. So I honestly think, because the debt levels are out of control on the federal level, that we're likely going to see rates continue to move upward, because the government doesn't seem to care or want to rein in or make any sort of cuts, and that to the lenders, to the government, they're going to require a higher level of premium there. So the great financial crisis of levels of rates. We also track the 10-year Treasury, which you can see here has moved drastically up from March, 4% to 4.71%. It's come down just a little bit briefly, but the trend is clear. It's been a pivot upwards. If you look at this on a 40-year chart, it's definitely hit an inflection point and is moving upwards. It's possible even that we see a Fed hike on the FOMC later this year, which could help influence these rates to go even higher moving forward. So we're going to be watching very closely, because obviously mortgage rates is the number one factor that drives housing. Why? Because we live in a payment economy, and if the middle class can't afford the payment, then they basically have to sit and rent or double up, and we're seeing that across the board. And so it's going to be impacting the housing market on a very, very high level. Now, there's a lot of distress under the surface, so it's not just that we have this setup of wealth inequality, but the people at the bottom, their debt to income ratios, or DTIs, are higher than the great financial crisis level today. So these loans that are being originated right now at record prices, these folks, 39.6% on new mortgage originations. That means that 39.6% with their new mortgage of their income is actually flowing out the door to service debt, which is incredible, because this is based on gross income, not even your net after your taxes and all that. So, I mean, honestly, after tax income could be more than 50, 60% out the door just to service your debt. You have to live on the remaining 40%. And that also gets taxed, right? Because you have sales taxes and things like that. Maybe you live in an area with state income tax. So your money is flowing out the door at a record high level. This is very dangerous for the marketplace to be able to buy at this debt to income ratios at this point in the market cycle, especially here in the Sun Belt, where we're very overbuilt on multifamily and on single family in certain pockets. That's driving prices down significantly. And here's the other part of this. The consumer is maxed out. This is the red line here. The personal savings is on the green line. Credit card debt is skyrocketing, right? People are living paycheck to paycheck. 78% of our country lives paycheck to paycheck, according to some studies. And the green line here, this is the savings rate. Again, it's just very, very low. So the consumer is maxed out. They don't have the cash. They're borrowing to be able to live. And this is a huge problem for the real estate market, because if you have too much debt and then you have job loss, there's no way you're going to be able to go out there and actually buy a house. And that is part of the reason why we're seeing pending home sales drop to crisis levels. This chart tells it all. This is a signal of what is to come next. You can see that we're grinding along the bottom for the pending home sales. We're worse than great financial crisis levels already, which is crazy because our population is larger. So we are truly in an affordability crisis, and it's just a matter of time until prices follow. Now, real estate moves at a glacial pace, and what I mean by that is even from the great financial crisis levels, prices started dropping in 2006. We didn't have Lehman until 2008, and they didn't stop dropping until late 2012 in most areas. So it took a 6-year, even with a forced selling from the banks with the government mandates, we still didn't see it happen for 6 years. So I believe that this is going to be some long-term grind lower until we see wages keep up, if wages keep up, or mortgage rates come down to bring back the demand. But obviously we're seeing pending home sales come down. We're seeing contract signings come down as well. We're seeing the number of closed sales be 30% below the peak. Now, 30% is a crash. So when we say Florida is crashing, we say that's because it's crashed from a transaction standpoint, not from a price standpoint. Prices depend on where you are, and it also depends on what type of product you have. Obviously, condo prices in some areas have crashed. Townhouses definitely in some areas as well. Single family has held up stronger, but if they're around new construction communities, there's a possibility that they may have crashed, which is the 30%, especially when you count in how much the new construction is offering in incentives and compared to the price that they had previously. But this is what we talk about in terms of a crash. A lot of people use it loosely. I just want to be specific here in terms of what is happening in Florida. Now, obviously, when you have pending sales decline, less contract signings, less closed sales, the amount of inventory rise, but we're also seeing new listings that are coming on the market rise across the board. So this is the 4-week total of new listings of U.S. homes for sale that's seasonally adjusted since early May. And you can see that we're just rising here. No surprise going into the end of the year. A lot of people are trying to move before the end of the year, sell their house. But I think there's a fear gauge out there as well, as people can see what's happening and they're listing their house trying to get the highest price they can before the market really does shift, especially if we see mortgage rates move higher from here. Now, we are absolutely in a new construction recession. This is the U.S. home builders' fourth year of recession. You could see that this number is just skyrocketing here. This is the 3-month average of new homes for sale divided by the monthly sales. And you can see that we're now at a 9-month supply of housing inventory for new construction homes. We were at this massive low right in 2020 at 3.37, and it's just skyrocketed. I expect this to continue to move up. I know a lot of builders basically slowing down their sales as much as humanly possible in terms of their construction. They're doing less housing starts, but we still have a glut of supply that's shadow inventory that hasn't even hit the market or shown up on MLS yet, that's just sitting there basically vacant, and the builders are being very careful and slow not to push all their inventory onto the market at once and depress the sales. So they're just taking their time. They're providing incentives instead of doing price cuts, and this is part of the reason why, right? The government's going to manipulate things, the builders are going to manipulate things to make things as slow as humanly possible, so that way they don't feel the pain, or they draw out the pain over many years versus just 1 year. So you just need to be a savvy consumer to understand where we are in the market cycle and what is happening. So buyers, looking at new construction, majority of the time you have total control of negotiations. Work with a top real estate agent who knows how to offer, how to get the incentives. If you need help, reach out to me. I can connect you with one of those agents. My information is below in the description. Just send me an email. I respond to every email personally. But this is something you really want to look at if you're looking at buying new construction. Clearly, new single-family home prices have peaked in 2022. The Fed started raising rates here in March of 2022, and then obviously impacted the market 6 months later. And then we've seen prices slowly drift downward again. This does not happen overnight. Look at this. This is 1, 2, 3, 4 years of steady decline. It could be another 4 or 5 years of steady decline until we get back to some reasonable rate. But again, it depends on what the government decides to do. If they're going to go ahead and try to manipulate mortgage rates lower to keep this from honestly crashing. New listings are on the move. If you don't follow Melody Wright, you should. She's great on X. July new home sales adjusted at 50K, down 5.66% year over year and 15.25 month over month. The median sale price is down as well month over month. And they're explaining there's about 10 months of supply, right? So this is just what we're talking about. But this is what I wanted to show you here was new home sales price versus existing homes, right? So an existing home median sale price, according to the National Association of Realtors, is $434,000. The new home sale price is $393 per the census, but the incentives that are reported by these builders are significant, up to 12.9%, according to Lennar. So the real sales price looks closer to this, which is basically $90,000 less for a new home than an existing home. Okay, so this is because they built too many of these new homes and they oversupplied price points that people cannot afford. They didn't build affordable housing. They built the mid-level luxury. So there's not a housing shortage, there's a housing mismatch. And so you need to understand the nuance between those two, because the media will just make you believe that there's still a shortage that just doesn't exist. The physical structures are there, just people can't afford them. And obviously the builders are concerned. Their sentiment is run soft, affordability strain subdues their orders. Their orders are dropping, so they're providing more incentives. And you need to be really careful if you're a buyer buying in one of these communities, because you could buy a house in that community and then a couple months later, especially going into the end of the year, you should know this, the builders report at the end of the year their annual earnings, some in November, some in December, some in actually October. So you got to figure out which builder you have, and if it's a public builder, and they give massive incentives going to the end of the year. So if you were to buy something now, and then you wouldn't have the negotiation power you might have in a few months for the exact same product, and somebody down the line could save an extra 50K that you didn't save, and now you're underwater 50K when you go to sell for whatever reason, because you have to compete with those people. So this is something you really want to be thinking about if you're doing new construction. And obviously all of this starts to show distress. More and more Americans are having a harder time keeping up with their home and car payments. We're seeing record levels of repos for cars. The home distress is starting to pick up. We're starting to see a slight uptick in foreclosures. And what I mean by slight is that it's just like from a percentage basis, it might say 40%, but it really is just a slight uptick. It's going to take time for all this to play out for foreclosures. Banks have to process them through. Some of these states are judicial states where things have to go through the courts. And so this doesn't happen overnight, but we can obviously see the distress under the surface is starting to happen. And when that happens, the government starts to find ways to keep things going for as long as possible so whoever's in power can stay in power. Treasury announces upscale buyback operation for longer term debts. That sent yields lower. It's since come right back up because the bond market is ginormous and the government is not going to have control of it. They're going to be able to influence it for sure, but they're not going to be able to fully control what happens here in the treasury markets, and what happens in the treasury markets will spill over into the mortgage markets. And so this is something we're keeping a very close eye on. We will continue to keep you updated on that. So look, I'd love to hear from you. Where are you? Comment below. What are you seeing happening in the next 6 months? We are going to have serious seasonality going into the end of the year, especially at interest rates, the highest level they've been in the last year. So my expectation is that things are going to continue to slow. You're going to continue to see pending sales decline. You're going to continue to see more contract cancellations. If mortgage rates move higher, I think it'll continue to slow things. Going into the next year, we won't really see another bump until March of next year. So if you're a seller, keep that in mind. The seasonality is a real thing and things are going to feel slow. And again, if you're looking for a top agent, it's more important than ever to have a top agent to sell your house. This wasn't like 2020 to 2022. You could hire anybody and they could sell your house like a hotcake and it didn't matter. Now you need a top agent who actually knows what they're doing. They can price you against the competition. They can get your house to a point where it'll actually sell. So if you're looking for a top agent, reach out to me, send me an email. I'd love to connect with you. And we're building a national network right now. So if you're a real estate agent watching this as well, go to movewithmomentum.com and go submit an application if you're a top agent and want to be part of our program. Thank you so much. For more housing data, visit movewithmomentum.com. Thank you for following, and I'll see you next week.